Tickets go on sale for the StubHub IPO in April. Will retail investors get front row seats? And will SeatGeek be scalping IPO tickets soon after? eToro filed for an IPO this week. It claims to be pro-retail investor, but forgot to offer IPO access to its customers. And CoreWeave's dirty laundry came out in the S1. Does a scaled-back launch put the brakes on other aspiring public companies? In IPO Radar news, the Cerebras IPO is delayed even further. Discord takes the next step toward an IPO, and OpenAI is raising a shit ton of money. The AI hype cycle rages on. Welcome to the Access IPOs podcast, where we explore opportunities to invest in the world's most innovative and disruptive pre-IPO companies. I'm Craig Stevens, founder of AccessIPOs.com, and I'm not a professional investor. I'm not a San Francisco tech bro. I'm just an ordinary investor, probably like a lot of you, who just wants to invest in great growth companies, whether they're private or public. And that brings us to IPOs, because when they IPO, they finally become easier to invest for most retail investors, where before that, it's a little bit harder. And right now is a great time because we've got 5 legit IPOs in the pipeline, and that's a great sign for public investors. But this first one, CoreWeave, we got to start with that one because people were excited about this one, and the venture capitalists really pumped up the value on this company, but the dirty laundry came out in the S1. So underwriters set the price range at $47 to $55 per share. About a week later, we learned that this is not going to go out at that price. It's going to go out at about $40 a share. And that's a huge disappointment when you're investing in IPOs. You want to see high demand. You want to see oversubscription at the high end of the price. I mean, sometimes you'll see that range, and then they'll come up with the price at $60 a share. Instead, we're at $40 a share, and that shows that there's just very little enthusiasm for this CoreWeave IPO. And a big part of that is due to debt and the business model of this thing. They're comparing it to WeWork, which WeWork, everyone knows, has failed. And a big part of that was the capital intensity of that business plan, where they had to invest lots of money to buy out these properties and hoping that the growth and the profits would follow. But with CoreWeave has to invest all this money into GPUs. The problem is that the GPUs lose their value over time, and they're borrowing against these GPUs, these Nvidia chips, to buy more Nvidia chips, and they need to buy the Blackwell chips. They're still on the Hopper chips. They need to buy more Blackwell chips, and we know that chips are going to probably evolve faster than CoreWeave can keep raising money, and it's losing money. It's got debt to pay, and just it's not looking good for this IPO. So lots of scrutiny for this CoreWeave IPO. There's no moat. There's lots of debt. The GPU turnover is very high, and they're using the GPUs as collateral for the debt. Just a lot of red flags here that really didn't come out until that S1. We pointed to some negative articles, and CNBC's been dumping on this, and all kinds of pundits out there are dumping on this. And when you see that IPO price lower from 47 at the minimum of the range to 40, then you know that Wall Street investors and the institutional investors are not buying at those levels. They've lowered the price. And then the day that value came out, that $40 a share, we found out Nvidia was planning to anchor this thing, quote, anchor this IPO at $40 a share with a $250 million order. And so that's great to see that Nvidia wants to prop this thing up or buy in at that IPO price. It doesn't mean it can't go below that. You also may have Wall Street banks and some of the underwriters pumping up shares. We don't really know how this is going to turn out. But what we do know is that enthusiasm has really waned on this company. There are several red flags in the business model that we can't sort those out in a couple days, reading one S1 and seeing one IPO. This is the kind of company that needs to prove itself a bit. And the market is the place to do that. We want to see these companies in the market proving themselves. And if it's the legit high growth company that's supporting the AI phenomenon over the next couple decades, then go ahead and show us. Bring us the quarterly numbers. Show us that these contracts that you have with Microsoft and OpenAI are going to bring in more contracts and that this business can survive. But right now, a lot of questions about survivability of CoreWeave, let alone just getting this thing out the door. I will say that I pulled my shares out of Robinhood. I did put in a request originally, but seeing this price come down and seeing the action and the negativity going into this deal, I removed my request for shares. I'm just going to watch this one on the sidelines. I don't need to participate. We do hope that there's some positive reception so that other AI companies aren't afraid to go public, and maybe we start seeing some momentum with these other companies that we've been talking about, like Klarna and Hinge Health, and another one we'll be talking about today, eToro. So it's great to see CoreWeave IPOing and getting out there and showing itself off, but I think investors want higher quality and better business models, at least more established and proven business models that are investable for the long term. So good to see IPOs happening. Unfortunately, this one may not be the one that we were hoping for. Speaking of better business models, StubHub filed for an IPO on March 21st. This is another one of these IPOs. It's been in the pipeline for a while. They actually were looking to IPO last September, but in July, they famously said that they were going to pull back the IPO filing due to choppy market conditions. Of course, 2024, market conditions were not choppy. They were pretty much straight up. But for whatever reason, they pulled the IPO, and it is now moving forward probably in April. So StubHub is this middleman market maker where they don't have any inventory risks. The sellers takes the risk on inventory. And so really what they're doing, they're a technology company. They're an app that's going to facilitate these trades and offer some guarantees to buyers and sellers. But this is a classic two-sided marketplace, which can be a very good business. It's essentially a technology company. It's fairly high margin business, and it says in their S1 has limited variable costs with each transactions. They're still losing money. So we have to look at this thing and decide, why is this company losing money despite the fact that they've got this pretty solid business model? And so I'm sharing my screen right now. We got the StubHub S1 filing up here. We haven't gotten the terms yet. We're waiting on the terms. Lots of nice pictures and some pretty good highlights here. So a couple things interesting in this S1 filing. This business was founded in about 1999. This guy, Eric Baker, came up with the idea because his girlfriend wanted to see Lion King on Broadway and he couldn't get tickets. So he shared this idea with his Stanford Business School classmate, Jeff Floor. And Floor left Stanford to start this business. Baker came back and started helping with the business after he graduated. But Baker was eventually fired from the company. Floor went on to sell StubHub to eBay in 2007 for $310 million. Baker went off to start a company called Viagogo that was primarily based in Europe. He never signed a non-compete contract, so he built this Viagogo up and eventually bought StubHub back from eBay in 2019 for $4.05 billion right before the COVID-19 pandemic. And so this guy Baker buys this thing and pretty much overpays going into COVID, but obviously recovered now. But the funny thing about this S1 is that there's no mention of Jeff Floor in this S1. It's like the history just passes over the real history of this company that goes back to 1999 in the Stanford. And so I saw this pointed out in, I think, a CNBC article or someone else, but it's almost like this guy, Eric Baker, is trying to rewrite history, or there's some sort of petty argument they had in 2007 when he got ousted. And his way of saying F you to this guy is to just kind of erase him from the history of the business. So there's a nice little history in the S1, but it leaves out this fairly important detail that Eric Baker was forced out. They sold this to eBay. He came back and bought it, which is a great founder story. It's a great comeback story for this guy to be telling. Baker is rewarding himself with the risks that he's taken. Baker owns about 5.2% of the Class A shares, but he owns 100% of the Class B shares, which have a 100 times voting power compared to the Class A shares. In other words, he owns 90% of the voting power of this company. Eric Baker owns StubHub, and he's going to be the one driving this company. So if you are investing in StubHub, you are investing in Eric Baker's ability to run this company, and that's fine. We love founder-led companies, and this guy has taken a long road to get here. So kudos to him for doing that. And this seems to be a good time for this company to go public because the revenue growth has been solid. In 2022, about $1 billion in revenue, 1.36 in 2023, 1.77 in 2024. So decent looking revenue growth. Of course, this is after COVID, right? So they took a major hit during COVID and been rebuilding since. I do think this is a decent business, even though there's still a net loss. The net loss has been decreasing. So this is on the upswing, potentially being a profitable company. I think the issue that some investors are going to have is that we don't like these companies. We hate transacting with StubHub. I posted on X or Twitter about StubHub, and immediately somebody responded, some anti-StubHub account who just doesn't like this company responded and pointed out something negative. And these ticket companies, going back to Ticketmaster and Live Nation, I mean, nobody likes these companies because they do gouge us. We feel like we're getting gouged each time we buy a ticket. And I've recently gone through this experience buying tickets, and I wasn't happy about the availability of tickets. I wasn't happy about the deliverability, and I wasn't happy about what I had to pay for them. But that's just the way things are right now. With the way the music industry has gone, with streaming and artists not getting the money to stream, they're going on live tours, and people are paying up for live experiences. And so the days of the $10 to $15 concert ticket that I used to buy 20 years ago are gone. And if you want to see any band with any name recognition at a big venue, then you're going to pay a lot of money. In baseball, let's not get started with baseball tickets or football tickets and the prices we pay for those events. I think generally people aren't loyal to these businesses. They just want the tickets. So StubHub could be a good business. The IPO itself is a different question. So far, we don't see any indications that retail investors are going to get a shot at participating in this deal. It would be great if StubHub sent an email to their users to say, hey, if you have an account with us, we're going to invite you to invest in this IPO. We've seen that before with Airbnb and Uber and Robinhood even. They offered IPO shares to investors because customers make excellent long-term shareholders. But that comes back to this issue. I don't know that there's a lot of loyalty with these companies, which brings us to SeatGeek. SeatGeek is also considering going public, and obviously it's going to be watching this deal to see if StubHub's IPO is successful. If it is successful, then SeatGeek could easily start filing for an IPO and moving forward with their public offering. And of course, we want to see that. We want these companies out there so that we can evaluate them over the long term and decide if we want to invest or not. And if they are growth companies, we want them to be part of our passive investing strategies. I have a lot of money in just passive index funds, and get these companies in there and let them be a part of that. And just more public companies is what we're always pushing for here on this podcast and on my website. So SeatGeek could be next. SeatGeek hasn't officially filed for an IPO yet, but the next company I'm going to talk about has. eToro is a longtime online broker trading app that has a decent number of customers, something like 3.5 million customers that use this company. It says here approximately 3.5 million funded accounts across our global footprint of 75 countries. So it's nice to see a more of an international trading app. And I get a lot of emails from international readers who are always looking for access to IPOs, and they can't get them just living outside of the United States and not being able to invest in Robinhood IPOs or SoFi IPOs. eToro does not offer IPO access as far as I know. It never has. So this is an 18-year-old company. We're looking at a $2 to $3 billion IPO, which is really nothing to write home about. They raised money in March, about 2 years ago, March 20th, 2023, at a $3.5 billion valuation. They raised $250 million. These investing apps, they're just not all that exciting. These aren't great businesses. I made a mistake years ago owning Ameritrade stock 20 years ago, and I kept waiting for it to rise. I just thought this was a great business model in the internet age. These brokers got rid of the thing that made them somewhat profitable was the commissions. And when they dropped commissions, when Robinhood came in with commission-free trading, they had to find these other ways to make money. And right now we see Robinhood scrambling to diversify away from the trading apps. It's going to banking. It's going to certainly crypto for trading, but also membership fee. So you put your money with them and earn a high yield. And they're now moving into wealth management and robo-advisory. So Robinhood is desperately trying to get out of the trading business. Now, they'll always be in the trading business, but to diversify away from the trading business. And eToro seems more like a one-trick pony. I'm not seeing a lot of other services that this company does other than being a trading app. Everyone has education. Education is free, so no one's going to write home about that. Copy trading, a lot of people are doing that, and social trading. I think this is one of the earlier social trading apps where you can share with your friends. I've never bought into that. I never thought that was all that exciting. Copy trading, if you want to buy Nancy Pelosi's portfolio, go for it. And then it's sharing this trust score of 4.1 out of 5. It's not a great trust score to be sharing on your homepage. I'm kind of surprised they put that there. So I'm not excited about this company. It is on my IPO radar as a fintech company. I think the business here is interesting, and I haven't done the research on this. I'm not a stock analyst. I haven't done the research on this, but I do think that the international aspect of this, the fact that they're in 75 countries, maybe there are some other countries where they're charging commissions, or they have a business model that's not in such a competitive space as the US. I mean, there are so many brokers here in the US. It's a highly competitive space. We still see these online brokers come out all the time trying to compete with Robinhood, and the big ones like Fidelity and Schwab. It always blows my mind. There's just new brokers every year trying to pull in this social idea of investing, which again, I'm not a big fan of. I don't think it's necessary. What we want is low prices, low fees, access to funds, and a good user interface. I will say that I don't like the Robinhood user interface. I don't like the Webull user interface. I don't like the Moomoo user interface. And I don't like the SoFi user interface. I like Fidelity quite a lot. M1 Finance is pretty good, and I have brokers with all of these because of my IPO business and whatnot. I just don't see this exciting a lot of people. It's on our radar, so we'll be watching it. And the biggest disappointment with this IPO is if you do a search on retail investors, and I'm doing this on my screen, if you just search for retail investor, it comes up 48 times, and they talk about how they're empowering retail investors and giving the retail investors what they want. But it says nothing about giving retail investors access to the IPO, which is what we want. We want access to your IPO. You're not giving it to your customers as far as we know. There's nothing in here, at least in the initial S1 filing, there's nothing in here about a directed share program offering shares to customers. And at a $2 to $3 billion IPO, that's probably why it's just not big enough. The underwriters are going to take all the shares. They're going to give it to their best customers. So Goldman Sachs, Jefferies, USB, Citigroup, they're going to take all the shares. Retail investors are probably going to not get access to this one, especially because access might mean partnering with someone like Robinhood to deliver shares or SoFi, and eToro doesn't want you opening an account with those companies. There's got to be a way for them to offer shares to their customers. Haven't seen any evidence that they will. I'm going to hold out a little bit of hope for their amended S1 when they release terms that we'll see a directed share program in there, but I'm not holding my breath. eToro, we expect to see this one in April. I also expect it to happen after Klarna, and if this goes well, we could see Chime and more fintechs. We do see some crypto fintechs moving toward IPO, so if Klarna and eToro do okay, we're probably going to see Kraken, Circle, and we have reports that Gemini, the Winklevoss twins, their crypto exchange, we have reports that they have filed confidentially for an IPO, and we could see that this year. So good sign for fintechs, but Klarna, eToro, they need to deliver. Hopefully there will be better reception than what's happened so far with CoreWeave. Remains to be seen. All right, on to IPO Radar news. These are companies that I follow on my website, accessipos.com. There's somewhere around 150 to 200 companies that I track actively, tracking their news, tracking their IPO likelihood to see what private companies are moving along toward their IPOs and how do we invest in those before their IPOs or at the IPO price so we can invest at the ground floor as these become public and grow into the future. Of course, fewer companies are IPOing, so the earlier we can own them in the private markets, the better. First up in radar news is Cerebras. So Cerebras is a chip maker. They make these big-ass chips for AI. They're designed specifically for AI, and they improve inference, which is when you talk to ChatGPT and you get a fast response. That's inference, how fast you respond. And a big part of AI is just that fast response because we don't want to be sitting around waiting for responses like we're waiting for a Google search or anything else on the internet. You want it to happen fast. Cerebras is considered a Nvidia competitor, and everyone knows that the demand for Nvidia chips is unlimited at this point. At least that's what it seems like. Cerebras makes darn good chips. Now they have to build out their capacity, but it is a competitor. It's considered an AI pure play, and it was supposed to be the first AI pure play to IPO. It filed back in September, on September 30th, but about 8 days later, the federal government stepped in, this group called the Committee on Foreign Investment in the United States. Essentially, Cerebras had concentration issues with its customers. It has a very large customer in the UAE who is also an investor. And so the U.S. government stepped in to say, hey, we're going to take a look at this relationship, take a look at the risks involved with this IPO before we let it happen. Since then, we can presume that Cerebras is out looking for new customers, and I'm sure it's getting new customers, and it's going to diversify its customers as it builds out its manufacturing capacity. If indeed demand is unlimited for AI chips, then Cerebras is going to have a place to sell. The news came out of Reuters that said the Cerebras IPO is further delayed as the security review continues. What it seems like actually is they haven't really identified the people to do this review. They still need to fill some spots. It's been delayed further as executives wait for the White House to fill key appointments to wrap up this review. A lot of us were hoping, or a lot of people were hoping, that the new administration comes in and they would just let this thing go, which would align to their deregulation, their hands-off government talk. I'm not sure that's all been confirmed, but that was the hope, is that this thing would just disappear, this CFIUS review. It hasn't. They're still looking to fill some key components. So all we know is that this thing's going to be delayed further. At this point, we don't know when. It's still on our upcoming IPOs list, and we hope that they can diversify their customer base before the next filing comes out, and we'll see that in an amended filing. We'll probably get a news leak from Reuters before that happens, so we will be keeping an eye on it. It's good to hear just any update from Cerebras because we just haven't heard anything since October. So getting this update at least tells us, hey, this is happening. They're looking at it, and hopefully they can eliminate this, what's perceived as a national security risk, and move on with this IPO. There was a very good interview with the CEO, Andrew Feldman, on the Harry Stebbings podcast this week, or the same week that this article came out. And Feldman is someone who anticipated the need for this AI compute way back in 2015. And Stebbings asked him about that at the top of the show. Like, what did you see back then that you knew would lead to the need for this kind of processing? So it was a very fascinating interview, a little bit technical, but you do get a sense of why these different types of chips need to be developed for AI and why Cerebras is the one that's going to deliver them. And there is a pretty big moat when it comes to building out this kind of technology, manufacturing it. Now, if they can operate and build out that manufacturing capacity to really scale, that remains to be seen. They're going to be very capital intensive. And hopefully we see this company go public so we can watch them do it with full transparency to the public markets. And then investors can decide if they want to invest or not. Until then, we'll be waiting for this government review to come through, and we'll wait to see that before we get a chance to invest. The next company we'll talk about on the radar today is Discord. Discord just 3 weeks ago was talking about early stages of discussions with banks, and we got an article from Katie Roof this week out of Bloomberg. And Katie's one of our favorite reporters. She gets tons of scoops, and she's been scooping Discord news. Discord is working with Goldman Sachs and JP Morgan. They've selected banks. And why this is significant is that just 3 weeks ago, they were in early stages, and now they've selected a bank, which means looks like they're going to be moving forward in 2025. So the next step is going to be a confidential filing. They'll be working with the banks to put that together. So in the next 6 months or so, we're going to wait and see if we start hearing more about potential confidential filing or any more timing on the IPO. And if they can get this thing out to the SEC in the next few months, or maybe in 6 months, get it reviewed, get feedback, we could potentially see this one go public by the end of the year. The best comparison for Discord is Reddit. Reddit had a fantastic IPO in 2024, early 2024, and the stock was up 400% afterward. Reddit is a forum. It's an online forum and community social networking type of company, and Discord is a very similar kind. Discord offers more chat functionality, more privacy functionality and different settings. I even think there's some video and other types of ways to connect to a community on Discord. CEO Jason Citron was on Harry Stebbings, and he wasn't real eager to go forward with the public offering, but he did want to provide shareholders liquidity, early employees, early investors liquidity. And the best way to do that is through an IPO. So we'll be watching Discord over the next few months for the next steps moving forward with its IPO. Last but not least, and I can't believe we haven't talked about this company yet, OpenAI is a bit of a news whore. They're always in the news. They're always talking about something, or there's always an article, some sort of journalist reporting on them. Sometimes the news are interesting. Sometimes it's just fluff. It's really not that interesting, or it's Sam Altman bloviating his company, or someone else saying that AI is going to change the world. And nobody disagrees that AI is going to change the world. When you start hearing stories like OpenAI is looking to raise $40 billion at a $300 billion valuation, and looks like this deal is going to go through. We had heard valuations as high as $340 billion, but this $40 billion raise is massive compared to just 6 months ago. In October, they were raising, I think, $6.6 billion at a $157 billion valuation. Valuations just doubled in 6 months. And going back to early 2024, I think they raised at about $80 billion valuation. And that's where I believe the Fundrise Innovation Fund and the ARK Venture Fund invested. So a lot of readers, Access IPOs, and myself included, we invest in this venture capital fund called the Fundrise Innovation Fund that owns several pre-IPO companies that would otherwise be nearly impossible for non-accredited investors to invest in. Fundrise Innovation Fund holds OpenAI, and if indeed this is a $300 billion valuation, this is going to be like a 3 to 4x return on that investment. Of course, it's just part of the fund, but that's why we're investing in it, because we want to be able to participate in some of these crazy private market gains. So I'm happy to see that from an investment standpoint, and I think a lot of Fundrise and ARK Venture Fund investors are going to be happy about this. But $300 billion valuation is very high. AI is starting to feel even more bubbly than it was just a few months ago. And we've talked about the AI hype cycle, how technologies tend to grow really fast and they get overvalued, and eventually they fall off their peak and sort of level out and grow at a more reasonable pace. And that's what we saw with the internet, and all signs are kind of looking like the AI hype cycle is in real effect here. But no one knows how long that's going to last, and valuations can keep going up before they fall. This is a scenario we're going to be watching. It does feel like the hype cycle is in full effect, but I think it's prudent to have a healthy amount of skepticism with AI going forward, especially at these lofty valuations. That's all for this episode. If you like what you're hearing here, there's 3 ways you can support the show. The first is to like or follow the show or subscribe wherever you consume your podcast, whether that's on Spotify where there's video, or YouTube. There's also a video on there. You can subscribe there. The second way you can support the show is check out the links in the description. I have links to my newsletter, so you can sign up for my newsletter. It's free. I'm moving that to weekly, so you'll get an update every time I publish a new podcast or a new article during the week. I'll be updating that and sending that out in the Sunday newsletter. Also in the description, you'll find links to the Access Club, which is a private community where I share more real-time information on news, IPOs, curated news, and curated investment opportunities. So if you're looking to invest in certain deals, I aggregate where all the deals are available and what companies, and put them into posts on the Access Club. There's a link in the description below. You'll also see a link in my homepage, so go there to check it out. And finally, the third way you can help support the show is to write a review wherever you consume your podcast. Ideally, it'd be a 5-star review. If you want to write a 5-star review, you like what you're hearing, please go ahead and do so. If you don't think this is a 5-star show yet, I'd love to hear your feedback to tell me how I can get it up to a 5-star review. Send me an email, either reply to my newsletter or put a comment in the YouTube description or Spotify or wherever you get your podcasts, and I will get your comment, and I'd love to respond to you. Best way is through email, so subscribe to the newsletter and then just reply to any email you get, and I'll get that feedback. And trying to improve the show every week. I'm still in the ramping up phase, but I'm really enjoying this, and I'm glad you're able to join me today to listen to the show. Thanks for watching, thanks for listening, and I'll see you next week. This video is not a recommendation to buy or sell any startups mentioned. Pre-IPO and IPO investing involves significant risk. Conduct due diligence by reading the SEC S-1 filings before participating in IPOs. Do not invest in IPOs with money you cannot afford to lose. Thanks for watching.